Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With today's video, it's another YouTube subscriber request to examine the financial services company Principal Financial Group. They provide financial products and services to businesses, individuals, and institutions. They offer retirement plans, life and health insurance, wellness programs, as well as investment banking, etc. Now, what you see here that's quite interesting about this company is notice that the operating earnings per share have grown at about 6.4% a year. I'm going back as far as I can go here, back to 2002. But I do want you to notice they initiated their first dividend in 2002. I also want you to notice that they cut the dividend in 2008 during the Great Recession, but then they've raised it again. Now, the long-term record of this company is decent. It's actually underperformed the market over this time frame since December of 2001. On a capital appreciation basis, it outperformed it on total dividend income, but it's been pretty close. It averaged 6.5% annualized return versus 7.1%. But I do want you to notice a couple of things about this. I think it's important to talk about. The company was fairly valued at the beginning of 2002, as I'm drawing this graph here, and it now currently looks undervalued. Its normal PE ratio over this time frame has been 12.9. That's the PE ratio of this blue line. It can currently be bought at a 9.9 PE with a 3.9% dividend yield. The company's A- rated and has actually a very excellent debt-to-capital ratio of only 19%. So I would consider this an undervalued opportunity, and if you look back historically, the best time to buy this stock when it was undervalued. So even though it has not outperformed the market over this time frame, you might also notice that we're measuring at a very inopportune time for the company because it's undervalued currently. And if you looked at the stock market itself, you would find that it was overvalued. So let's just look at that very quickly. This is a long-term graph of the S&P 500. This is over basically the same time frame or a very similar time frame that we were just looking at. What I want you to notice is the S&P 500 is trading above its normal PE ratio now of 17. It's trading at a blended PE of 19. So we're kind of comparing apples to oranges here. We're comparing the performance of an overvalued selection to the performance of an undervalued selection. On the other hand, from a perspective of current investment, the S&P offers a dividend yield of 1.9%, and it is overvalued at a PE of 19.3, where in contrast, Principal Financial Group can be bought at a PE below 10 with a 3.9% dividend yield. So the idea here, this is a really excellent time to be buying this stock according to what I'm looking at here on the fast graph. So let's look at forecasting a little bit. There are 13 analysts forecasting 13% growth for this fiscal year, followed by 13 analysts that expect 6% growth for next fiscal year. Now, if we go to the normal PE ratio calculation, for the last 5 years, the normal PE has been 12. And you can see that this has been pretty consistent. These are historical normal PE ratios. So a 12 PE ratio, I'm going to actually drop that down to the 12. That would be what I would consider to be an attractive valuation. If this company were to move back to that 12 PE, and in effect these earnings estimates were to come to pass, you would have an opportunity for a 28% gain between now and the end of the year. That would annualize out at about 73%, but go out to the next year and you would have a 36% gain out to the end of December 2019, or an annualized rate of return about 26.96%. Now that's pretty darn attractive in my way of looking when the current dividend yield is already 3.9%. That's significantly above average. From a standpoint of the analyst scorecard, if you look at how accurate the analysts have been able to forecast this company, you can see that when they were making their forecast 1 year in advance and 2 years in advance, they've really hit the numbers, extremely well. So that just simply tells me that the odds of these forecasts are probably reasonable. Now I can also go into Yahoo here, and I've got $5.70 and $6.05 for the next 2 years estimates. If I look here, I got $5.67 for the 1 year, 3% less. A different number of analysts, 14 analysts here, but I've got $6.05, which is really the same number looking at Yahoo. So the consensus, utilizing a couple of different sources here, is pretty much on the money. 567 versus 570 and 605 is equal. And there's one more analyst in the Yahoo universe that I just showed you. So this company looks very attractive right now. It's one that I would want to consider if you're looking for current income. This is Principal Financial Group's operating cash flow. I don't look at this as much for evaluation, so I like to take price and even the normal price to cash flow off. What I'm really looking for here is dividend coverage. And from what I see here, the company's operating cash flow more than adequately covers their dividend. And likewise, if I look at it from a standpoint of free cash flow, which is what's left over after what they cost to run the business, I also once again see that this company generates substantial free cash flow. So their dividend appears to be very safe. The company has low debt. I can also run this through EBITDA real quick, which is another valuation reference that I would look at that's cash flow oriented. And when I put price on the EBITDA graph, I also see that the stock looks undervalued based on its normal price to EBITDA of 9.5. It's currently trading at a price to EBITDA of 6.1. When I also look at it from a standpoint of dividend yield, last year when the stock was a little more fully priced, let me get the price off of this graph so we can see that, the dividend yield was 2.7. That was as of December of last year. Now we're looking at a 3.9% yield. And as you can see, that 3.9% yield is on the high side when valuation is typically low. That's when you get these higher yields. So all in all, I think this is an excellent candidate for the dividend growth investor. It has good prospects going forward. The analysts seem to be pretty much in agreement. We're going to get some decent growth for the next year or two. So this might be one, if you're looking for income and some growth of income, you might check it out. The only caveat there, of course, is to recognize that they did cut their dividend in the last recession. So that's something at least you should be considering in your analysis here. Nevertheless, thanks for watching. I really appreciate it. If you're interested in learning more about fast graphs, you can call this number 813-960-9600 and ask for Polly, or you can sign up for a free trial, or just give us an email at www.fastgraphs.com and we can get back some more information to you. This has been Chuck Carnevale saying thanks for watching.